Welcome to Your Money with Leo Daprile. I'm Leo Daprile, and each week on AM570, Dan Rivers and I will talk about anything and everything to do with your money. If you ever have questions, please feel free to call me at 330-533-6936, or you can email me at leo@gemyoung.com. Enjoy the show.
Time now for Your Money with Leo Daprile. Leo has advisory services offered through Gem Young Wealth Advisors, LLC, a registered investment advisory firm. And Leo's in the studio here this morning. We'll see you next week at Eastwood. Good to have you. How you doing, sir?
Good, Dan. It's good to be back in Boardman.
Yeah, it's nice nice to be back here. We got something right off the bat here that I'm not very aware of, but you can tell me a little bit about it. The Secure Act, which you're talking about, changing retirement a little bit here. I've read a little bit about it, but explain this, the Secure Act.
Well, the federal government is broadening the rules for retirement planning, making it easier, especially for small employers to have 401k plans. Mm-hmm. Although we've had simple plans for years, they're much more limited than a 401k plan in terms of how much you can contribute, in terms of flexibility, in terms of what an employer can put in. But the upshot is those plans were free. In the perfect world, everybody should have a 401k, but typically if you had less than 10 people, the cost of a 401k plan was prohibitive. You just couldn't justify it. So along comes the Secure Act, and one of the things it permits is what they call a multi-employer plan. In other words, you can get together with other small employers and put together your own 401k plan. That way you can benefit just like a larger company. Now, that helps small employers in several ways. Number one...
So you have A and B put together, two companies.
Correct.
A and B. What about this Secure Act now? What does that mean for people out there that may have an account right now?
Well, one of the things that's appealing is in this multi-employer plan is when you didn't have a 401k, this puts small employers at a competitive disadvantage when hiring maybe key personnel. So now that they can play on a much more level playing field with larger companies, so that can help bring stronger talent to smaller companies, which excites me. To see that that's something that's now available.
So do you have to seek these companies out, or do they help you find a match?
We're going to actually start putting together our own groups.
Really?
Mm-hmm.
I'll be darned.
Yeah, we're excited about it.
Yeah. So you'll take a couple of companies that you work with right now that are not eligible for this.
On their own, and combine them to start giving them more of that benefit. Absolutely.
All right, very good. So that's kind of a good thing. That was just signed that's a Trump initiative, right?
This happened a couple of weeks ago.
Okay. All right. President Trump signed the Secure Act this week as part of the government spending bill, and it will inevitably affect most retirement savers, right? People out there that are just saving for retirement. Some of the things that it covers, annuities, right? 401k plans? Yes,
and let's talk about this. Let's talk about buyer beware of an annuity within a retirement plan.
All right.
You know how I feel about annuities. They're an appropriate investment vehicle in the right circumstance with the right person. But as a general rule, that saying an annuity is good for everybody is not a good statement to make.
And one of the reasons for that is that you're already protected, and that it's like double protection when you have an annuity inside of a 401k, right? You're tax deferred.
Correct.
First of all.
Correct. That's exactly right.
And then you're tax deferred again with an annuity.
So you lose that advantage of an annuity. But here's why they're becoming popular. And here's why why the government is allowing them back into retirement plans. People are looking at their balances, especially as they get to retirement, and they're wanting that traditional pension income, and having an annuity alternative within the plan, permits you to take your money that you save for retirement and turn it into a pension-like income. So that's where the appeal's coming from. But I would caution, especially younger people, and if they're fixed annuity products, that there's a risk of underperformance. Because remember, an annuity in its pure sense is a pretty conservative product, okay? And it's geared more towards the conservative investor, especially in today's world, with all the new indexed annuities that are out there, those new products that are available, which a lot of the new indexing techniques is yet to be tested. And you know me, Dan, that's the skeptical guy in me coming out.
What do you mean by indexing? Just using that term. I know what indexing is, but what do you mean in the terms of an annuity?
And the modern day annuity, with interest rates being so low, it's difficult for an insurance company to pay you a decent interest rate based on the yields they're getting from the bonds. Okay. So what they've done is they've developed different techniques by buying essentially futures contracts on, and I'll make it simple, like on the S&P 500, on what the value may be a year from now. And based on if the market goes up, let's say 10% next year, the index will pay the insurance company a portion of that gain, and then you participate in part of that gain.
Why do we need all of these intricate things that are hard to understand?
Because people want a higher return, so they're trying to figure out ways to have higher returns. And this index strategy is really a way for insurance companies to offer a product to those people where the annuity is appropriate to try to get a higher return than they would get, say, in a CD.
And the downside, and we've discussed this a number of times, the downside of buying an annuity is that there is a large commission taken up front, right? So it takes a while for that company to make money on that before they can put any money back into the annuity for you, correct? I mean, the first few years that a company is using annuity, they've already paid a commission, right? So they're scratching back to get back to even because they've paid less. So if you buy a $100,000 annuity, the commission on that could be $5,000 maybe?
Or more. Yeah. And a lot of annuities today, there's even some today that are becoming more fee-based in terms of an annual fee instead of an upfront commission. Mm-hmm. So I'm glad to see that product's coming out. That's why annuities have such long surrender charges, because the upfront costs and commissions that get paid out, they amortize that normally over between 7 and 10 years to get that back.
Essentially, the safety of an annuity then is that you're likely not going to lose your money if you have bought it from a reputable company.
That's
pretty accurate. I mean, if you've got a solid company out there that's tried and true, have a track record, and you follow them religiously, you're likely not going to lose your nest egg.
Likely. I'll say likely, but it's possible that you can lose money on an annuity.
Yeah, I mean, but yes. That probably would be the case where the company made some bad investments and they've gone out of business.
Or overpromised on the products. Mm-hmm. Typically what happens, and that's when they've overpromised on the guarantees that they provide, and that's what really got the variable annuity business in a lot of trouble. Mm-hmm. And that's why a lot of variable annuities became so expensive, because they had a lot of death benefit guarantees that they couldn't honor. So they had to keep increasing the price inside the contract.
Remember they used to sell something called Universal Life, a variable universal life. Is that product still sold?
I haven't seen a variable universal life in many years, and it was one of those things from a theoretical perspective, was a great idea. Nobody could figure out how to do it cost effectively is what it really came down to.
Yeah. One of the cautionary tales about annuities is that people tend to move them. They get tired of them, don't they? And you get tired of them too quickly. You have to read the fine print. Many of the annuity companies, they will charge you a surrender fee unless you've kept it for a number of years. I'm going to say that if you buy an annuity, probably the most liberal would they maybe allow you to surrender it after 2, but many of them are up to 5 to 10, aren't they?
7 to 10, I see a lot at, and for a lot of people, again, and I'll defend it as well to a point that annuities are appropriate for some people. They're not as appropriate as many of the people that buy them. There's some people out there, Dan, that simply don't want any market risk. Mm-hmm. They can't tolerate it. They can't stomach it. So that for that person, an annuity would be an appropriate product to have a conversation about. But I see so many other people that when we talk about the annuities that they're in, a lot of people don't understand what they're in. And something else too, Dan, and one of the things I've come to learn over the years is, and this is investment products overall, this isn't exclusive to an annuity, is the more moving parts there are to that investment, the more assumptions that there are made to get to a return on that investment means there's more opportunity for things to go wrong.
Mm-hmm. Yeah, I mean, it's a complex instrument, too. When you say about things that are going to go wrong, it really takes a keen eye to be able to read through it. Of course, most of the language that's going to affect the consumer is probably found in a couple of paragraphs, right? You're talking about surrender charge, and you're talking about whether or not you're going to annuitize, which brings me to another question. I see so many people that basically have an annuity, can't wait to get out of it, and they never annuitize. Because annuitizing means what? That they're now going to pay you a fixed amount of money until your death.
Correct. And
How many people do that? How many people really take those to the bitter end?
Not many that I've seen
many.
at this point.
Yeah.
Excuse me, not many that I've seen at this point because.
Hey, Mike, water, please. Can we grab me some water? If you will.
Because at this point in time, the problem becomes the idea of annuitizing sounds good, but then when people get to that point of annuitizing and they see what the payment looks like, here's the balance of what it becomes. Is the payment's lower because life expectancy continues to improve. So the longer people expect to live, the lower your monthly payment is going to be out of your annuity. Okay? But the bet then becomes if you think you're going to live far beyond what your expected life is, then annuitizing it does make sense to me. Okay? In that situation. We've had people that we've had some annuities that we annuitized in the 80s. Okay, when people weren't expected to live long.
I mean, the selling point was this. Here, you invest this money with me, and at age 65, we're going to pay you $2,000 a month for the rest of your life. Correct. Isn't that pretty much how they work? But I don't know of anybody that ever thought that was a good idea here recently. Years ago, they were sold like that, right? You go back, hey, buy an annuity, put that money in an annuity. By the time you get to 65, you can couple this with your Social Security money. It really sounds good. But somewhere along the line, people decide, I'm going to get out of it. And, when you're getting out of it, that money has just really gone sideways for you, hasn't it? You haven't really gained much on it.
In some cases, that's true. Some have done fairly well. But the differential is on the older annuities, people weren't expected to live long. So when they did annuitize and they did outlive that, a lot of annuities paid big dividends.
Right.
But now with the new mortality tables, if you're 70 years old and thank you, and if they're putting you on a payout of 22 years at 92, and if you're looking at it saying it's going to take me till 92 to get my money back,
right.
Then and really no return on my money over those 22 years, that's why that's a challenge.
What do you like? I mean, you probably don't sell a lot of those things because of all the complexities in them. When people say, you know what, I'd like to have a fixed amount of money when I turn 65 years of age, what do you steer them toward doing? A managed account?
Well, first thing we do is we take product off the table.
Right.
And what we look at is say, okay, when we build a financial plan for a client, the overall objective is what rate of return does this plan need to work for your retirement to be successful?
Right.
Okay, so that's the genesis of where we start. Then from there we have a conversation of which products will help us execute that strategy the best. Okay, whether it be a managed account, whether it be an annuity, and that's not an often used product for most of my clients, but we have on occasion.
Is there just two ways to go? I mean, annuities or managed accounts? Managed accounts means that you are actually basically taking ownership of this person that you're managing in all aspects of it. It could include some annuities, but not all. I mean, you could have a variety of things. Are not all accounts managed?
The accounts that I do are managed because we want that active management. We have active strategies that we're trying to deploy. So there's monitoring that needs to go on a daily basis for those accounts.
And you're somewhat hamstrung, are you not? When you have when you have an annuity, there's not a lot you can do with that portion of money. That's but if you have something where you have somebody invested in some treasuries, you have them in some bonds, you have them in some stocks, maybe some mutual funds or these kinds of things, that gives you, as a manager, a lot more flexibility. But what about the risk to the investor?
So let me ask you this, Dan. Do you think you're different than you were 5 years ago?
Yeah.
You think your life's been pretty dynamic during those 5 years?
I'm learning how to do this show now. Yeah, 5 years ago, I knew less.
But my point is we're dynamic people.
Yeah.
So if we're dynamic people, it's more difficult at times to have your money in a static product.
Mm-hmm.
That's not adapting, changing, and flowing with you. However, to your point, you bring up the risk. The risk is a very important part of every conversation I have with a client. How much risk, and it's not how much risk people are willing to take. That's how we're used to asking the question. But the real question is, how much risk do you really not want? You know, what can't you really tolerate instead of what will you tolerate?
Okay, here's the other question I have for you. If, in fact, the insurance company sells you an annuity, and let's just say, for lack of lack of being complex, that you buy a $200,000 annuity, that if you keep it till age 65, it's going to pay you $2,000 for the rest of your life until you die. Why does it have to be so highly commissioned? I mean, it seems to me that it'd be a pretty easy sell. Why do they pay so much in commissions? Because one of the issues is if they're taking maybe 3 or 4 or 5% up front, then they really have to have great gains to get that back.
The argument for that, in their defense, would be if you amortize that cost over time, it's not a big cost.
Right.
So if you kept the product for 20 years like they intended you to keep, and that cost got amortized over time, then it really didn't matter what was paid.
Got it. Well, we got off on the annuities, but let's move on to this. We've certainly educated you a little bit on that. Required minimum distributions have changed for non-spousal account inheritors under the current law. What does this mean? And the Secure Act, it requires beneficiaries there's withdrawals of all assets within 10 years. And again, we're getting back to the complexity of this with this new simplification.
This is a biggie to me.
Okay.
Because in today's world, and I have exact situations like this where grandparents are leaving maybe their IRAs to their grandchildren because their children are well enough.
Yep.
You can then take that IRA that grandpa had or grandma had and give it to their grandchildren, and then they can take payments out over their lifetime. So they can supplement, and if they're 40 years old, the grandchildren are 40 years old, they can supplement their income for 40 to 50 years. So and I have some clients taking what we call our required minimum distributions from a beneficiary IRA and using that money to fund their own retirement account. Just so using that, take it, pay the tax, turn around, put it in here, it's tax deferred, so it's almost a tax-free exchange to a point. So while the problem now is with the law change is that money has to come out over 10 years. So at 10 years, it's got to be spent. So it's really accelerating the distribution from the IRAs, which is going to accelerate tax revenue in taxable situations for the beneficiaries of these IRAs.
Yeah, this is more complex than talking about Social Security, isn't it?
It's getting to be, isn't it?
Did we have another meeting of the Fed this week? And did they make any pronouncements?
No announcements coming. In fact, I'm looking outside. I came here with sunglasses on, and it's snowing outside.
You got snow?
Yeah, I don't think I'm going to need those on the way home. Or way back to work.
Exactly. I was looking across. I walked out and I looked across at Mr. Anthony's, and we had sunshine rising. It can change awful quickly.
Yeah.
But in any case, is there any? We've had the market going a little bit south, but this week, but mostly that's because of the issues with Iran and Iraq. And that really has nothing to do with our economy, does it?
No, but this geopolitical risk is starting to play out a little bit in our market. And in our markets, that's what was showing this past week. So that's a recession risk that if this escalates.
Why would that be? Because it seems to me that Iran and Iraq are really not very big players. Iran has a little bit of oil. Iraq has a little bit of oil. But we're not so dependent upon that. What do you think makes the markets jittery over this? Just uncertainty of maybe shipping in the Straits of Hormuz and stuff like this?
Good old-fashioned fear of what another war could do to the country. And typically, from an economic perspective, wars are good, because you need to produce more things for war. So that tends to be good. But, it's an international economy now. There's international trade, how that's going to be affected. So that's why there's more negative implications for that.
In regards to the trade deficit, we really don't have anything done with China yet, do we? I mean, there's the calming of the waters because we're supposed to sign a trade agreement. But somebody reminded me that the trade deficit with China is still north of $500 billion a year.
That's true.
Yeah, and nothing really has been done. That really does have to be tackled, doesn't it?
Well, I think part of the issue is we're just a bigger consumer. So I don't know how much of that trade deficit we're really going to reverse, quite frankly. That's why I think the tariffs that are in place, I think a lot of them should probably stay because it's already been baked into our economy. It's been baked into the pricing, and it's leveling the playing field, and it's slowing a lot of Japanese companies down from trying to take over from us economically. So I think there's been some good economic benefit for us. I think it's made American companies more competitive.
Yep.
So
and the stock market, as far as you can see, do you think that we will have a good year through the election? Right now, the indications would be that people are buying, right?
The economic indicators that I'm following are still sound. I'm still concerned about the big risks of mine are still the student loan debt. That's getting, and where I'm getting concerned about that is an interesting article in the Journal today. What's going on with that there's a lady that's 50 years old that's got $250,000 in student loan debt. She's got 2 undergraduate degrees, 2 masters, and a doctorate degree. That's how you amass that kind of debt at 50 years old. But with the new changes that came out in 2009 from the federal government, it's an income-based repayment schedule. Guess what her repayment schedule? Guess how old she'll be when she pays off her student loans?
I glanced at that, but she's going to be in her 80s before she retires. That isn't she?
114.
I should have glanced harder. Well, she can forget that one, huh?
Right.
But,
what you read is her last loan comes due in 2083.
Oh, okay. All right.
Crazy, isn't it?
You'll be at work and ready to help people with their financial goals, right?
That's the threat.
All right, very good. And search Jem Young. You'll find them in Canfield. Easy to find around the Tippecanoe area. If you want to jot the number down, 533-6936
or leo@jemyoung.com.